Welcome to a special episode of the CEC Report. It's the 12th of July. I'm Robert Barwick, and welcome back to my special guest, Philip Soos of LF Economics. Welcome, Philip.
Great to be here, Robbie.
All right, last time Philip was on the show, we called it Only Fraud Can Turn Around Falling House Prices. That was about 6 weeks ago. So today we're discussing the banks have a green light for fraud, but will it work? So, Philip, we discussed a lot last time you were here for nearly an hour, and it's been a very popular interview. And we had the interview in the context of a huge amount of hype, post-election hype, the property market's turning around. And I must say, in my view, that you're one of the few that kept your head. Amidst all this hype, I called you up and said, what do you think? And you rattled off reason after reason after reason you thought it wouldn't work. And 6 weeks later, I think the weight of evidence is on your side, right? Whatever little bit of hype there was there is really petering out. And there's a lot of headlines about little tiny things we'll talk about. They're making mountains out of molehills. Oh, this could be the turnaround, green shoots, yada yada. But anyway, it's all fake. So let's just go through the sort of things that have happened, and we'll start off talking about the authorities, what they have done since we last spoke. That is just panic actions. Like, they are panicked like you wouldn't believe. And the first one is from the Assistant Treasurer, Michael Sukkar, probably Sucker, last week, telling the banks to loosen their lending standards, which when you hear that, I think, well, when I hear that, but I'm sure when you hear that, that's code for go back to the kind of fraud you were doing before.
Oh, very much so, Robbie. It's clear that the establishment is in real desperation at the moment, and for the housing minister to make such a call like this clearly shows he wants the banks to keep lending out as much as possible to both homeowners and investors in an attempt to reflate house prices.
Because remind viewers again what the banks were doing. The Royal Commission was the change we saw. What were the banks doing with their lending before that they had to tighten up, and by how much?
Well, previously to the Royal Commission, especially up to the peak of the housing boom, up to 2016, 2017, the banks were just lending out huge sums of credit to anyone who had a pulse. Yeah. Up to that point in 2017, the average loan-to-income ratio nationwide was about 8 to 9 times. And in Melbourne and Sydney, it peaked at between 10 to 12 times income. So those are massive amounts of loans being originated by the banks. And it comes as no surprise that house prices, especially Melbourne and Sydney, were hyperinflated to peaks. In fact, we know that Sydney breached $1 million for a median priced home, which is insane. Maybe you would expect that in Monaco, yep, or New York, or yep, London or Tokyo, the global centres, but definitely not down here.
No. Now, Sukkar said something to the effect that, if we find it, we'll put the exact quote on the screen. The expenses of a borrower have nothing to do with their ability to repay or whether they're going to default or not. And what do you think of that statement?
It's a scam, because we know that the banks have been using income benchmarks like the household expenditure measure or the older Henderson Poverty Index. And through my research, if you take the typical first home buyer household, they've got a disposable income, annual income of about $100,000, and they've got expenses outside of debts of around $65,000. So about 2/3 of their budget consists of expenses. Yeah. So they have about $35,000 left over to spend on debt payments. But what the banks have been doing with this household expenditure measure is using a very, very frugal, unrealistic estimate. The basic variant is $34,000. So the effect of using that in the loan serviceability models is that it basically doubles the maximum size of a loan that the typical first home buyer household can take on from about $400,000. It doubles that to about $800,000.
Wow. And so when the Assistant Treasurer and Housing Minister is saying to the banks, because the banks, they stopped doing that, right? And I think the statistic that came out the week Suka made this recommendation was credit growth has dropped to 3.7%, which is an all-time low, right? I think this figure's been recorded since the 1970s or something.
Yep.
And at 3.7% mortgage credit growth, you're not going to get prices back up.
Well, that's why the establishment is panicking.
Yeah.
We even saw this last year with some RBA officials saying the same things. And when it comes to the interest rates, I remember in late 2018, Philip Lowe, the head of the RBA, said that the next interest rate move will be up. And yet we've seen two very quick cuts in succession. And it's been said by some investment bank analysts that we could see 0.05 by the end of this year or early next year.
And you saw the headlines, didn't you, that this is housing is as affordable now as it was in 1999 based on this serviceability. That's all they're thinking about. If we can, because all the things they're doing, what Suka is telling the banks to do, what Suka is telling the regulators to allow the banks to do, what the RBA rate cuts mean, and also the APRA changes. Haven't they brought forward their scrapping of the serviceability benchmark buffer from 7% down to plus 2.5 of the mortgage rate? All these things, aren't they designed to allow the banks to go back to making bigger loans?
Absolutely. We saw in February this year that the head of APRA, Wayne Byers, he said, regardless of how the housing market trends, our minimum 7% serviceability rate is set in stone. Well, it turns out about 4 months later, it's not so much set in stone after all, is it?
No.
And so that's...
Actually, can I say this? The day I met you a few months ago, we were in a meeting and you raised that and you said, someone who's tracked APRA and mortgage fraud, you said APRA did the right thing for once. You gave them a compliment. And already, your better instinct has been has been confirmed that they've actually scrapped it.
Yeah, so they've switched from a 7% minimum floor rate to the prevailing mortgage interest rate plus a 2.5% buffer. Now this will, given the typical loan interest rates that are currently being originated, this can bring down the total interest rate from about 7 to 6.5, 6%. So that does help borrowers to take on slightly larger loans.
Well, the day the interest rates were cut to 1% by the RBA, the headline I saw on the news that night on Channel 9, maybe Ross Greenwood or something, is we could soon see mortgage rates of less than 3%. And if that's true, if that actually happens, you're talking about a total interest rate buffer of under 6%, right? And of course, that'll help them make these bigger loans. The question is, will it work? Is any of this actually going to work? Because first of all, what does it mean? When the public see the government taking these steps and the authorities, resorting to these measures, what does it mean is the real state of our market? Doesn't it mean, shouldn't people be interpreting and saying there's nothing spontaneously driven by the market that's going to cause a turnaround? This is all artificial measures trying to create hype to get a turnaround rather than something organic, right?
Oh, very much so. The establishment knows full well there's something up with the housing market. It's clearly a gigantic bubble. And they've seen it deflating since 2017. And so now it's panic stations after 2 years. So they've all gone in the last few months, starting probably a month before the election. We're seeing the APRA make the changes, we've seen the RBA, we've seen the Liberals come in with their first home buyer subsidy. But to an extent, the establishment is somewhat trapped. Because if you look at our last recession in the early 90s, the RBA cut interest rates from 18% down to 4.75%. That's total cut of 13.25 percentage points. With the GFC, the RBA cut from 7.25 down to 3%. That's 4.25 percentage points. But now they were starting out just back at 1.5. Now they're 1, and we're not even into an official recession yet. So the RBA has very little room to manoeuvre. Furthermore, because we're getting to the zero lower bound, this is where the bank's net interest margins become compressed.
Yep.
So unlike in previous years and decades, the banks will not be able to pass on the RBA's interest rate cuts as fully as they did back then. So it's going to be even less effective this time around.
On households that have more debt than last time around and more mortgage stress than last time around, especially when other expenses are building up, etc. No, these are you can see the fakery everywhere. So one of the things that they've been crowing about, Philip, is when they say there could be a turnaround, is we are seeing. Well, I saw the CoreLogic put out this daily index that claims that on the daily index there's been an increase in prices. How they measure that, I have no idea. Whereas the quarterly index and the annual index are still well down, right? But then they're talking about the auction clearance rates. So this was the big headline. We discussed this in the show last week, but you're quite an expert on this. These auction clearance rates, when people hear this headline, what should they be looking at?
Well, first they should take a deep dive into the data that gets released every weekend. And I compared Sydney, Melbourne and Australia as a whole from 12 months ago to the rates last week. And what it showed was that volumes have collapsed, even though the number of sales are almost the same, if not slightly higher. So take for Sydney, for example, this would either imply that the average sales price for a Sydney dwelling has collapsed by 40%, or the volume data are too wrong because it's too low, or the number of headline sales that are being quoted is too high. Something just doesn't make sense here.
So they can't have it both ways. If they want to have these headlines where they say we're having these great sales, they have to acknowledge their data means the fall in prices is much bigger than anyone has admitted or measured, and we actually don't believe it's that much, right? If it's that much, it means Tony LaCantro in Perth has won his bet with Stephen Koukoulas already. So CoreLogic maybe should pay that out. So they're either saying that, or if they're saying prices haven't dropped that much, and we don't think there's evidence yet they have, it means the sales figures are completely inflated.
Yeah, it's quite a possibility there.
No, so these are the things that people have to understand. And in our last interview, I told the viewers, stop the show and go get people who are thinking of buying a home, because they've got to know this. They're being hyped into the market at the moment, right? Get in, get in, get in. All right. So those are some of the things that have happened since we last talked. And when you see that much desperation, you've got more desperation and less hype 6 weeks after we had a discussion where it was all hype, right? And that's telling you this ain't turning around anytime soon. There may be, I think you've acknowledged this, you can have these little dead cat bounces while it's going down, but people shouldn't misinterpret those.
That's right. And on the point of the daily house price index, no housing economist takes that seriously. Right. It's just a marketing gimmick. Yeah. Because we know in our title system, it takes up to 3 months for all the sales documentation to find its way into the state level titles offices, which then can be on-sent to the private sector data houses, who then run their tests and smooth out the data and so on. So whatever data that comes out, it'll take up at least to 3 months, and that means for CoreLogic, for Domain, for the ABS, for SQM. So whatever comes out now, don't really take it seriously.
Well, that's an important point. If there's 3 months for processing, how can you read anything into one day's figures? Okay, let's now talk about Western Australia. Regular viewers of the show will know that we had a CEC seminar over there a few weeks ago. We invited the economist, outspoken renegade economist John Adams, he of Economic Armageddon, to come and address our seminar. And John and I spent a few days before the seminar driving around, and we went to Mandurah, which Philip knows very well. We went to suburbs in Perth like Ellenbrook, and then we went to the northern area of Perth, right out of town up to, I think it's called Yanchep. I'd actually never been that far north before, of Scarborough. And what we saw was rather shocking, right? Now, when we went to Mandurah especially, we were told, go to Mandurah, you'll see lots of for sale signs. And we turned off the main road into the one of the roads that take you to the waterfront there. And we started seeing them straight away. And that section of Mandurah between the waterfront and the main road, right? So closest to the water, there were for sale signs everywhere. And people have given us feedback. We've only seen a little bit, right? And then north of Perth, we saw a lot of stalled development. So we were taken around by an Irish person named Owen, really great guy. Owen lived through the housing crash in Ireland in 2008. And Owen admitted to me, if he hadn't gone through that experience, he wouldn't be wary of things like debt, etc. now, and be seeing this. And so he feels like the only person who can see what's going on around him. So he took us to these areas, and he was just, all these stalled developments. They're just sitting there. He said this is like what Dublin's like, right? That have been caught out by the major housing crisis in Western Australia. So you've seen the show that John and Martin did, which I appeared on in the Interest of the People, which I recommend people watch on the Interest of the People channel. It's called The Economic Massacre of Mandurah. Just give us your general impressions of what you saw.
Well, I've been to Mandurah, Perth, all throughout WA numerous times over the years. And all the way into up to the GFC, Mandurah it was boom times. According to the famous Demographia report, Mandurah was the third most unaffordable region in Australia at the time. And then when the GFC hit, something cracked and it never quite recovered. And the mining boom held it up for a while through to 2012-13. And from there, it just came basically off a cliff. Yep. Prices and rents have come down by a third. Population inflows have weakened. It's very much a retirement town. But for as long as those fly and fly out workers came in and spent, things were pretty good. And now it's over the last 5 years, things have taken the tumble for the worse.
Now, it's 30% down in nominal terms, but it's even worse in real terms, right?
That's
Explain that difference.
Well, it's the difference between nominal and real is just the adjustment you make for inflation, which is typically positive, around 2 to 3% per year. The thing about Perth and Mandurah during the times of the mining boom was that inflation was actually quite higher due to the much stronger wage growth and a lower unemployment rate. But now that's certainly not the case anymore.
So it's about 40% down in real terms in Mandurah, and all of WA, which is roughly about 20% down nominally, is actually about 30% down.
That's right.
So when I was there, I had this. We're from the East Coast, and John's from near Sydney. I'm from Melbourne, like you, Philip, and we'd been looking around our areas, and we haven't seen anything yet here like WA. And so my impression when I saw this is, oh my God, if the rest of Australia was like this, Australian banks would already be in trouble. That's what I wanted to put to you. Do you think how much trouble do you think the banks would be in if the big markets like Sydney and Melbourne become like Western Australia and Mandurah?
They would probably come very close to insolvency. Definitely the NPLs, the non-performing loan rate, would rise much higher. They'd have a lot more bad and doubtful debts to deal with on their books. And that is why the establishment is in such a panic. They don't particularly mind that if places like Perth, Mandurah or regional Queensland or Darwin take a bit of a hit, because by value they account for
small markets,
too small a piece of the pie in Australia. But overwhelmingly, Victoria and New South Wales, or Melbourne and Sydney, account for just over 2/3 of all value of all property in Australia. So this is where the action is. And that's why the establishment is now gone all out with APRA making its changes, RBA cutting. And don't forget, the RBA is already engaged in QE. Yep. It's targeting bank funding costs. And soon it's going to move over to targeting government treasuries. And then it'll move over to targeting the bank's ABS and RMBS securities, even more so than they've done, to try and force down the yields and the funding costs in order to lower the mortgage interest rates.
So they would, when you say targeting those things, that these are asset-backed securities and residential mortgage-backed securities, the RBA would let the banks sell those to them so they can inject more money into them.
Pretty much, and by doing that, by purchasing them en masse, they can lower the yields.
Yeah.
And the intention is to try and lower the mortgage interest rate to try and get more lending happening.
One of the reasons I had this sense that this meant, translating WA to the rest of Australia meant trouble for the banks is from our last interview, you explained how at a, something like 20% down, this is when banks would start reaching clusters of mortgages that have been structured to avoid things like lenders' mortgage insurance, etc. And if it would mean a lot of mortgages don't have any equity anymore, and the banks have to start putting up capital against those things, right? And how, when it's the Sydney and when it's the Perth market, we might be seeing signs of that. We've heard reports that some banks are just black banning whole areas and they're not lending to them anymore and maybe trying to draw money out of it, right? But in the big markets here, where would they get the money from to be able to hold the extra capital against those?
Well, that's the thing. The banks are currently in a squeeze at the moment, especially the big four, and that's why they're currently we're seeing reduced profitability, which is one of the reasons, probably the major reason, as to why they're cutting thousands from their workforce, because they're not being able to lend out as freely as they were. They're having to look to other areas of their business to increase short-term quarterly profit, and unfortunately, the workforce is one of those methods.
All right. You and I spoke recently since our last interview. It got a lot of attention, what we talked about, and people contacted you with extra information. I want to talk about some of those things now because they're worth explaining to the viewer the kinds of things that the banks do get up to try and pretend that everything's okay, right? So one of those things was, which was fascinating to me, is banks splitting loans on their own books at the back end. So what did you hear about that?
So since the last episode aired, I had a couple of people contact me from in and around industry, and they were telling me what the banks do is that on the front end, a borrower just may see their plain mortgage, say $500,000 principal and interest. That's just apple pie kind of stuff. But on your back end, the bank could split it up into 4, 5, 6 segments. And the purpose for this is to basically hold down the loan-to-value ratios and to also originate more interest-only loans, but to then disguise them as principal and interest.
Right.
So, for instance, if you had, say, $1 million mortgage, you had at the front end, it just looked like one plain mortgage, but on the back end, they've cut it into 4 segments. The first segment is a $700,000 interest-only loan, and then you have the last $300,000 cut into 3 portions of principal and interest, so 3 P&I mortgages. But because the bank then uses an unweighted LVR methodology, there are, by LVR, that's 75% principal and interest and only 25% interest only.
Right.
And so to the borrower and also to the data they provide to the regulators, the credit rating agencies, and auditors, it seems like a standard principal and interest loan.
Well, so okay. In case people missed that, just to interpret it, because this is what unweighted means. There's 700,000 and $1 million is divided into one lot of 700,000 and 3 lots of 100,000.
Yep.
But that's 4 parts. And they can use an unweighted average where they claim they are 4 quarters of the mortgage.
Yep.
And present their figures to the regulators and their own. They're fooling themselves. We discussed this last time. They're actually fooling themselves if they're doing this, right? But this is the sort of trick, and it's clearly fraud. I mean, what other intention is there? This is the sort of trick they're prepared to resort to just to pretend their books are better than they are.
Well, with the onset of neoliberal privatisation deregulation since the 80s, the banks have had a long time to optimise their mortgage systems to produce the outcomes they want.
Yeah, no, we're seeing that. You've been warning, or you've warned a little bit about this. We're in this period starting last year, or actually the year before perhaps, where the big spike in interest-only lending from started in 2012, they have been resetting because it's generally takes after about the main reset is 5 years later, right? We're in that, and you're pointing out we're not through the worst of it yet, right? The worst of these interest-only loans are coming in 2022. Why are they the worst ones?
Well, the interest-only reset is from 5-year period from 2018, 19, 20, 21, 22. And the reason being is that the first year of resets we're seeing in 2018, that was a vintage from of interest-only loans that were originated 5 years ago. So we're talking about 2013, 2014 vintage, and that's when the boom began in Melbourne and Sydney. Whereas if you get to the peak, which is 2016, 2017, that was the peak of when the largest, most fraudulent interest-only loans were originated by the banks.
Bigger loans, crazier terms, all based on the household expenditure measure, etc.
That's right, and lending against the equity in your previous property to buy the new property to add to your portfolio. And so we saw, as I said, the loan-to-income ratios going 10, 11, 12 times in Melbourne and Sydney. So you have these enormous interest-only loans. And the reason being is that the borrowers could never take out principal and interest because they couldn't afford it. And so when we get into 2021, 2022, towards the end of the interest-only rollover, that's when the worst of these loans will be converted. And already, even with the 2013-14 vintages, a lot of borrowers cannot make the principal and interest payments, even if the new principal interest loan has a lower interest rate. It's just that the total debt payments balloon anywhere from 20 to 50%, depending on the size and terms of the loan.
So this is already wreaking havoc. We're seeing that, but you're saying we ain't seen nothing yet.
That's right, because we're only 1.5 years into a 5-year conversion.
Yeah.
So it's not something that's going to happen straight away, but as time goes on, we have more and more loans converting, including larger and larger, more fraudulent ones, and that's going to cause quite a bit of trouble.
Well, tell me what you think of this. One of the people we chatted with in Western Australia when we were there is a mortgage broker who insisted that the market didn't have to be in the trouble it was in if the banks allowed, the broker said the banks had a policy of allowing investors to pay interest only for 10 years, and if they could just continue that, interest only in perpetuity, there wouldn't be any reason for the investors to bail out. That's what we were being told by a mortgage broker would be the solution to the WA property market.
That's just typical thinking by the industry, just think on themselves and no one else. These type of loans, if the only reason banks can originate them because the borrowers cannot pay the principal and interest, it's clearly not good for the individual risk for the borrower and also systemic risk across the system. Interest-only loans should have been made illegal a long time ago.
Yeah, for sure. And I was always struck when I read the Phil Angelides report of the global financial crisis in America. Very telling line in there. The maximum their interest-only loans got to was 25% of all lending. And this was in 2006 in the United States. We got to close to 50% in 2016, 2017. Okay, slight change of speed. You're an expert on mortgage fraud. I did want to get your thoughts on another form of fraud. So this week, we've heard the news that they've found yet another building in Sydney, which is crumbling due to poor construction standards. This one was actually the first. This was before Opal Tower. They had to evacuate it in the middle of last year, but they kept it cover up, and it's a joke. all you and I were just being briefed on the details, everything about it. The standards are so shoddy, it's not funny. So there's officially 4. They're coming in fast succession now. Gladys Berejiklian announced that self-regulation hasn't worked. Oh, duh.
Yeah.
But isn't it? I mean, what better word for it is there than fraud?
Oh, pretty much. In the mid to late 1990s, both the state and Liberal governments deregulated building surveillance and inspection. And so now that the developer and the builder were allowed to hire an inspector to sign off on their work, but this is what led to what's called a Gresham's law. The bad drives out the good. And in this case, it was a race to the bottom.
Yep.
The private inspectors that basically rubber stamped and gave what the builders and the developers wanted to see were the ones that got hired. And of course, that led to a race to the bottom in terms of rubber stamping the most appalling standards. And we know how bad it is. For instance, in 2012, a report from the University of New South Wales showed that 85% of all apartment complexes built since the year 2000 had some sort of serious construction faults. And a more recent one from Deakin and Griffith universities showed that around 75% of all apartment complexes on the East Coast have some sort of severe construction faults, and the average number of faults per shoddy construction was about 11.
Wow.
And in terms of the type of faults that we're seeing, by far and away, the worst is bad waterproofing and electricals, which leads to mould. This is something that Edward Almeida has pointed out constantly. The second is poor fireproofing, fire hazards, all that type of stuff. And the third is, of course, the cracking and the poor foundations. We're typically seeing manifest itself in the car parks first and then works its way up.
Yep. And those things, especially as Edwin explains, the main cause of the bad waterproofing is just speed. They're trying to get these things up way too fast because they're not building for. They're not thinking about the people living in there. That's an afterthought. And that's the crazy thing about the bubble. The actual purpose of a home, which is to live in it, goes right out the window, and it's all about it's your bank account now. It's your nest egg. It's a way for someone to make a quick buck, right?
But even worse, it typically takes around 5 years for these faults to start manifesting. So that means what we're seeing now pretty much comes out of the vintage of apartments complexes that were built, say, a half decade ago.
Yeah, right.
So what's been built during the boom, 2013, 2017, will soon start to manifest. And then right now, we've got about 100,000 apartments still under construction on the East Coast. And it would be horrifying to see what kind of standards they've been built to. Even now, Edwin has been showing pictures of buildings that are currently under construction and they're already cracking.
Well, we call Edwin Almeida undersupply because he's the guy who's been warning all the time there was an oversupply. But the problems that he has sort of been the lone voice blowing the whistle on for a long time. People are starting to get that this is serious. But I was just struck by what you just said because I think people need to have this more at the forefront of their mind. That there was as bad as this period has been for 20 years. There's been a much more intense period from 2012 to 2017 and even now. But that period was where the worst of the speculation, the worst of the poor lending standards, the worst of the fraud all happened in that era, that period. And we can therefore expect, as you've said, the worst of the construction standards will have been in that era. We've seen a couple with like Opal Tower was built in that time, etc. So, and that's why you're saying that the mortgage resets from that era. We haven't seen anything yet. So we've got a bad legacy here of dealing with a very reckless era of development in this bubble that we're probably only just beginning to see the sides of the problem.
Well, that's right. And as Edwin has mentioned, it's just not the apartment complexes, the big ones that get the media attention. He says the poor construction standards are rife all throughout the smaller, newer apartment complexes, houses and townhouses as well. But when it comes to the larger apartments, a lot of this is, when the faults do arise, a lot of this is settled as quietly as possible, because the owners obviously don't want media attention to this, because that could lower the price of their apartments, and nobody wants that.
No, for sure.
And you've also got the the flammable cladding scandal as well. With the state governments, they're sitting on their reports. They've got their own databases of all the affected properties, but they refuse to release it because that would devalue the value of the properties for the owners. But there's also an ethical dimension to this,
of course.
and that is, people may become a bag holder because they purchase a property that's known to have this kind of flammable cladding or any other kind of fault, and they're lumped with it, even though people knew beforehand that it was shoddy. That raises ethical issues,
Which the governments are complicit in.
of course.
Right. This is so much of everything we've talked about. We've got to change the language and start calling it for what it is, which is fraud, which is crimes, and we share our disappointment with the Royal Commission. It barely touched the sides of all these problems, because it's not, it's the banks, it's the governments, all have been complicit in this mess that is now our economy and our financial system. So on that note, just one last thing I wanted your thoughts on. What are your what's your sense going forward in the short term, in the medium term, where things may end up? You're the one who said 6 weeks ago you didn't think all the hype measured up to anything, and I think you've been right on that. Where do you think things will be going soon, the way things are panning out?
Well, we're seeing a number of quite powerful tailwinds basically meet up with a large number of headwinds. And so it's possible we might see a shallowing out of falling house price growth, maybe even some positive price growth in a couple of dead cat bounces, because the establishment is essentially running out of ammo.
Yeah.
The RBA is at record low levels. QE will have a limited effect. APRA, it would look very embarrassing for them to keep on cutting their buffer rate too much too soon.
Yeah.
And one very important issue that's yet to manifest is the court case between Westpac and ASIC over the use of the HEM. And that could swing either way. And even if, I've heard from down the grapevine, that even if ASIC loses the case and the industry is allowed to use HEM, ASIC will still move to try and push the banks to commit to using verified expenses. So that may not be such a win for the banks as they would prefer. But nevertheless, there's probably a couple of dead cat bounces, some stagnation in the market. But the thing about it is that over 2/3 of property investors are running a negative carry. They're negatively geared.
Yep.
So they're very much dependent upon not just small price growth, but very strong price growth to cover those losses and to also make a profit. And if that doesn't eventuate over the next 6 to 12 months, there's going to be big trouble in the housing market.
And I think one of the things that it just seems to me is, to get the turnaround they want, they need the borrower to share to catch on to the enthusiasm they're trying to generate. But it's easier for a borrower to be enthusiastic when they're seeing prices soaring. They want to get in, but they're not seeing prices soaring, so they've got to be take it on faith. And instead, all they've seen, and it's not clear to me how they're actually going to create that enthusiasm and confidence when, by all their desperate measures, aren't they undermining confidence themselves? I mean, if you're paying attention, you're thinking, boy, this government's desperate. If they're so desperate, do I want to be the one? I mean, you use the analogy of World War I trench warfare. Send them over the top into the machine gun nest. Do I want to be if the borrower thinks of themselves like that, do I want to be that person?
That's right. Do you want to catch a falling knife? And clearly, Josh Frydenberg, the Treasurer, has been saying we've got a strong economy, strong economy. He's been saying that ad nauseum. But if you look at the facts, we've got a weakening economy. And for the establishment to move so quickly just over the last couple of months with all these changes, when both Philip Lowe said the next interest rate move would be up, and for Wayne Byers, who said in February that no matter how the housing market trends, the 7% serviceability rate will be there to stay. And yet we've all seen quick U-turns. So it leads me to believe that something in the last couple of months has cracked in the system. Maybe residential construction loan market, something's gone wrong there. But of course the establishment would prefer to treat us like mushrooms, keep us in the dark and feed us rot. That's their method. And of course, public relations rot-wise, they say, oh, everything's fine. So it's difficult to trust what they say, especially given how fast they've been moving the last couple of months to cut.
And we were going to mention this before in relation to Western Australia, but let's mention it now as the final thing. This is an example of where even a scheme that the government has latched onto as, this could change things, this could turn around, which is this Key Start mortgage entry scheme in Western Australia, which I'll get to explain. What used to work seemingly really well, if they're relying on that, that's not going to work. So what's the deal with Key Start in Western Australia? Well,
it's basically a shared equity policy between the Western Australian government and borrowers. The government would help them get into the housing market, generally for low to middle value properties. And things were great for as long as prices were rising. They could refinance. But now that prices...
Just to explain that, so what the government would do is let people in on something like 2% deposit, but at a higher interest rate for an introductory period of time. And the purpose of that was when that introductory period of time ended, because the government was charging a higher interest rate, the borrower was encouraged to go to a bank and refinance to get a lower interest rate, but they already had a foot in the door. This was the logic. They had a bit of equity, foot in the door, and the bank would refinance that loan. That's what's come apart now, right?
That's right, because for as long as prices kept rising, they would have equity, and they could go to a private sector bank and say, look, I've got equity, my LVR is 80, 70, 60%. Can you please refinance me to a lower interest rate loan? And that was fine for as long as prices kept rising. But now we know that real house prices actually peaked in 2006 in Perth and have come down by about 30%. And that's a hefty cut, including a third of the value base in terms of rents have also dropped as well. And so you've got, especially in the post-Royal Commission era, these types of borrowers are simply getting rejected when it comes to refinance. So they're trapped in these homes with high LVRs, maybe even over 100%, with higher interest rates as well. And the whole reason that the state government helped them get into the housing market in the first place was that these were not, high income households, that they needed help. But now they really, really do need help. And I don't think the state government's going to do much of anything to help.
No. And a West Australian newspaper did an article on this a couple of weeks ago. We'll show the headline on the screen. They are trapped, these people now, that the prices are going down. And the idea that scheme could be rolled out around Australia and save the market is just futile.
Well, this is shades of what we're seeing with the Liberals' first home buyer subsidy. They just brought out on a whim just before the election. And it wouldn't surprise me if this somehow morphs into a much larger program to try and subsidise the first home buyers to get in.
Yeah. All right. Well, Philip, thank you very much again for appearing on the CEC report. Philip gives really good insights into the way this property prices intersects the banks. It's why the CEC is pushing hard for policies like Glass-Steagall, so you can reform the banks structurally so they don't get into this kind of behaviour again. It's why we're pushing for an audit of the banks. We need the Auditor General should be auditing them to see what landmines are lurking there on their books, right? Because the government is going to be on the hook for them when it all goes pear-shaped. And it's why we, because of these things are are real dangers in the system. It's why we're opposed to policies like bail-in, because it's mainly because it could be used, right? And you the viewer therefore has to pay for the crimes of the banks through losing your own money. So we'll keep pushing on with that fight. Again, Philip, thanks for joining us on the CEC Report. Thanks to the viewer for watching. Tune in next time for more.